the noble Duke of York, he had 10,000 men. He marched them up a hill one day, and he marched them down again.
Hey folks, welcome to this edition of Papaw's Pods. In the previous session, we talked about investing and the magic of compounding. Assuming you want to start investing and make compound magic work for you, how would you do it? In this session, we're going to talk about some different types of investments and why you should choose stocks, since this investment is long-term, then a little bit about how to pick stock investments. Now, you can invest in just about anything. Remember, investing is sacrificing now to get more in the future. So as long as you have a reasonable expectation you will have a future gain, it can be considered an investment. Realistically, though, at this point in your lives, you have three basic options: cash, bonds, and stock. Most of the others are too risky and too expensive. So let's start with cash. These are typically bank accounts, and you may already have a bank account that your parents set up for you. They are very safe and are often protected from loss by the U.S. government. What do we mean by safe? Simply, the risk of losing money is extremely low. Because they are safe, they don't need to pay a lot to attract money, so the returns are low. Some examples of cash are bank accounts, money market accounts, and CDs, certificates of deposit. Because they are so safe, these are good investments for money you may need in the next 3 years. Once you're on your own and no longer dependent on your parents, you will need to build up a cash cushion of 6 months' worth of living expenses in case you lose your job or have a major expense like car repair. Next, we have bonds. Here, you are loaning money to someone who promises to pay you back at the end of the time period, plus some additional money called interest. Interest rates and inflation can cause uncertainty with bonds, but the main risk is whether or not the party you loan to remains in business and viable over the set time period. So, for example, money you loan to the U.S. government, treasuries, or state governments, municipal bonds, are quite safe and pay low returns. So are bonds from a stable, well-financed company like Apple. However, bonds from a struggling, debt-laden company would be risky because they may go out of business before they pay you back. Therefore, they would have to pay you a higher return. Sometimes you hear these higher return bonds called junk bonds. Multiple bonds can also be grouped into a bond fund, where you get small pieces of many bonds instead of just one bond. An example bond fund is the Vanguard Total Bond Market Index Fund. Bonds typically are a little less safe than cash because occasionally they lose money for relatively short periods of time. So these would be investments for money you may need 3 to 10 years from now. Finally, we have stocks, which is the type we were referencing in the previous session when we were talking about a compound 10% returns. When you buy stock, you're purchasing a small piece of a company. If that company does well, other people will also want to own the company and will be willing to pay you more money to own your piece. If the company does poorly, less people will want to own it, and you may have to sell your piece for less money than you bought it for. An example of stocks would be a share of Microsoft or Amazon. Stocks, like bonds, can be grouped in a fund, where you get small pieces of many companies instead of just one company. An example of stock fund is the Vanguard Total Stock Market Index Fund. Stocks are the riskiest of the three types and pay the highest return. Cash almost never loses money, and bonds rarely lose money. Stocks, however, frequently lose money, and sometimes lose a lot of money. The total stock fund we just mentioned has been in business since 1992 and lost money in 6 of those years. The best year for this fund was a 37% gain in 1995, and the worst year was a 37% loss in 2008. So we can see right off the bat that investing money in stocks for a short period of time is ludicrous. Suppose we had invested in our $1,000 in 2008 and had to sell at the end of the year. We would not be happy campers. But we don't care about a year like 2008 or any particular year. We only care about the long haul, and over the long haul, stocks are the place to be. The Total Stock Fund was created in 1992, and since that time has an average annual return of 10.22%, assuming reinvested dividends, which puts it right in line with the figure we used in the first session. There's that phrase again, reinvested dividends. What does that mean? Some companies pay a portion of their profits back to their owners or shareholders, which is you. Usually these payments are made on a regular schedule, like quarterly or annually. As a shareholder, you can choose to spend this dividend money or automatically reinvest the money, which means buying more shares or pieces of the company. In our case, because we never intend to spend the money for a long time, we set up automatic dividend reinvestment. Every time we reinvest a dividend, we add to our total return. Indeed, this is the only way to approach a 10% return. Our return would be several percentage points lower if we don't reinvest dividends. So at this point, we know we want to invest in stocks, and we know we want to automatically reinvest any dividends we receive as shareholders. If you recall, you can buy one company or many companies through a stock fund. In our case, we want to buy a fund because that spreads the risk over many companies. If you choose one company, and then if that company runs into trouble, you will lose money. But if you buy a fund, even if a few companies struggle, the other companies will often keep your return positive. So we know we want to invest in stocks, we know we want to reinvest dividends, and we know we want to own many companies through a fund rather than just one company. We're getting close to actually picking a fund to invest in. But before we do that, we need to talk about 2 more things that could keep us from getting a 10% return: fees and taxes. We'll cover those in the next session. That's all for this
He marched them up a hill one day and he marched them down again. And when they were up, and when they were down, they were down. But when they were only halfway up, they were neither up